2025. Global stock market crash, causes, effects, and what's next. We've all seen the images. The panicked crowds of 1929, the Lehman Brothers collapse of 2008. These moments of market turmoil serve as stark reminders of the fragility of our financial systems. Today, we explore the possibility of another significant market correction, potentially in 2025. Is a crash inevitable? What could trigger such a downturn? And most importantly, how can investors prepare? We'll hear from leading economists, seasoned financial analysts, and historians who will offer their perspectives on the current economic landscape. They'll share insights into potential risks and opportunities that lie ahead. It's crucial to remember that predicting the future is impossible. Market dynamics are incredibly complex, and unforeseen events can dramatically alter the course of the economy. This is a speculative exploration, not a definitive forecast. Inflation has proven more persistent than many initially anticipated. This sustained inflationary pressure is squeezing corporate earnings and impacting consumer spending. How much higher can prices go before demand collapses? Central banks are responding with aggressive interest rate hikes. These increases aim to curb inflation, but they also raise borrowing costs for businesses and individuals. This could slow economic growth and potentially trigger a recession. Geopolitical tensions are escalating around the world. Conflicts and political instability create uncertainty and disrupt global trade. These events can have significant economic consequences, impacting investor confidence. Supply chain disruptions continue to plague various industries. Bottlenecks and shortages are driving up costs and hindering production. When will these issues be fully resolved, and what will be the long-term impact? Some analysts believe that certain asset classes are significantly overvalued. Tech stocks and real estate, in particular, have seen substantial gains in recent years. Are these sectors ripe for a correction? Government and corporate debt levels are alarmingly high. This debt burden makes the economy more vulnerable to shocks. Can these debts be managed sustainably, or will they lead to a crisis? Central banks are also reducing their balance sheets through quantitative tightening. This process removes liquidity from the market, potentially putting downward pressure on asset prices. What will be the full impact of this policy shift? Finally, we must acknowledge the possibility of black swan events. These are unforeseen events that can trigger a market crash. No one can predict these events, but we must be prepared for their potential impact. Imagine the initial market reaction, a rapid and dramatic decline in stock prices. Panic selling ensues as investors rush to exit their positions. The speed and severity of the decline can be breathtaking. Fear becomes the dominant emotion. Investors, driven by panic, make irrational decisions. This fear can exacerbate the crash, creating a self-fulfilling prophecy. Margin calls trigger further selling pressure. Leveraged investors are forced to liquidate their holdings to cover losses. This can create a cascade effect, pushing prices even lower. A liquidity crisis can emerge as credit markets freeze up. Banks become reluctant to lend, and businesses struggle to access funding. This can cripple the economy. The crash can quickly spread to other markets and asset classes. Contagion effects can amplify the initial shock, creating a global financial crisis. No market is truly immune. An economic recession is a likely consequence of a major market crash. Businesses cut back on investment and hiring, leading to a slowdown in economic activity. The severity of the recession will depend on the scale of the crash. Job losses will inevitably follow. Companies struggling with declining revenues will be forced to lay off workers. Unemployment rates will rise, impacting millions of families. Increased poverty is another potential outcome. As people lose their jobs and savings, poverty levels will rise. This can lead to social unrest and instability. The housing market is also vulnerable. A market crash can trigger a decline in housing prices, leaving homeowners underwater on their mortgages. This can lead to foreclosures and further economic hardship. Bank failures are a serious risk. Banks holding bad loans and investments may face insolvency. Government bailouts may be necessary to prevent a complete collapse of the financial system. Social unrest is a real possibility. Economic hardship and inequality can fuel social and political instability. Protests and demonstrations may erupt as people express their anger and frustration. Governments will likely intervene to try to stabilize the economy. Stimulus packages and other measures may be implemented to boost demand. The effectiveness of these interventions is often debated. Central banks will likely respond with monetary policy easing. Interest rate cuts and quantitative easing may be used to inject liquidity into the market. These measures aim to stimulate borrowing and investment. A market rebound is inevitable, but the timing and pace are uncertain. It could be a slow and gradual recovery or a more rapid bounce back. Investor confidence will play a key role. Long-term economic changes may result from the crash. New regulations and policies may be implemented to prevent future crises. The structure of the economy may also shift. What investment strategies are appropriate in the post-crash environment? Diversification, value investing, and a long-term perspective are often recommended. It's crucial to remain calm and avoid making rash decisions. What lessons can we learn from this hypothetical crash? Understanding the causes and effects can help us prevent future crises. Prudent risk management and sound financial policies are essential. In conclusion, while predicting a market crash with certainty is impossible, understanding the potential risks and consequences is crucial. By staying informed and prepared, investors can navigate the challenges and opportunities that lie ahead. The future of the global economy depends on our collective wisdom and responsible actions.